Well, good morning. Hi, this is Jennifer Corbett from OSC State Payroll Services. I'd like to thank you for attending day 2 of our 2021 Fall Conference presentations. Today's presentation is Workers' Compensation in PayServ. The presentation is being offered by Bureau of State Payroll Services, and your presenters today will be Ruth Belschwinder and Mara Koster. Before we start, I'm going to go over a few housekeeping items. Your microphone will be muted throughout the presentation. Using your headphones will increase your sound quality. The session is being recorded and will be posted at the end of Fall Conference. Up at the very top of your screen, you'll notice a blue control bar that expands to display your Webex controls. Any questions you have during this presentation should be entered in the Q&A feature up at the top. The questions will be monitored and answered later. This presentation is very full today. It should last pretty much the whole hour, so there may not be time to answer any questions at the end, but we will take all the questions, answer them, and it'll be included as an additional handout on the website when the presentation is posted. If you have any technical problems during the presentation, try signing out and back in using either the Chrome or Edge browser. If you still have an issue, though, you can email payroll@osc.ny.gov for additional assistance. You will receive a survey to complete after this presentation. Please complete it and submit the survey so that we can continue to improve your fall conference experience. Now I'd like to welcome Ruth and Mara to start their presentation. Thank you.
Thank you for the introduction, Jen, and thank you all for attending the session on workers' compensation in PayServ. I'm Ruth Belschwinder, and I took over as the team lead for workers' comp at the Bureau of State Payroll Services in December 2019. I have spent every day since then quite literally learning something new, as the saying goes. I was told it will be about 5 years before I know everything there is to know about workers' comp, but I have a feeling that's an impossible goal. I've never experienced anything as complicated and frustrating and challenging and even as occasionally fun and rewarding as workers' comp, and I can't imagine that will change with any amount of time in this position. Presenting with me today is Mara Koster, who many of you have worked closely with in the past year and a half, as she's our resident expert on workers' comp-related correct history requests and job transactions. I cannot imagine how much harder my job would be without her. To prepare for today's training session, we scanned our workers' comp email box, looking for your most frequently asked questions, and quickly recognized a pattern. Most of your questions are about workers' comp taxation and refunds, workers' comp job transactions, and the correct history requests that go with them, and supplemental payments. So we decided to focus this presentation on those areas of workers' comp that directly relate to PayServ, specifically what you can see there and what you can and can't do there. Before we get started, we wanted to let you know that we'll be posting a version of this presentation, including our speaking notes, later this week. We know that we're throwing a lot of information at you, so please don't feel overwhelmed trying to take notes today. You will be able to see them later. So first, let's talk about workers' comp tax exclusions, or what many people think of as the tax-free benefit. There are two components to this benefit that should be understood, both of which can be found in IRS Publication 525. First, payments received under a Workers' Compensation Act or a statute in the nature of a Workers' Compensation Act are fully exempt from taxation. Second, once an employee returns to work, any salary payments made for performing light-duty work are taxable as wages. This is why it's important that your employees are moved into and out of workers' comp leaves as timely as possible. In New York State, we comply with the non-taxability of these workers' comp earnings through a system of tax refunds. Employees receiving workers' comp-related earnings are initially taxed, and then our workers' comp exclusion process generates tax refund checks. Let's take a look at that process. When an employee is injured, your payroll office is notified and you put the employee on the appropriate workers' comp leave in PayServ. which causes PayServ to create a new workers' comp leave page for that leave for that employee. Then our workers' comp exclusion program, which runs on a 6-week lag, reviews the employee's paycheck, comparing the dates of the workers' comp leave on the workers' comp leaves page to the dates of the check being reviewed to determine how much of those earnings should be excluded from taxation. The exclusion program then adjusts the taxable gross wages for that check and calculates the refunds owed based on the taxability of the exclusion. 3 separate refund checks are issued, one for each tax category. Earnings code WSA refunds federal taxes, WSA refunds state taxes, and WSM refunds the combined Fica taxes, Social Security and Medicare. One of the questions we get most frequently is when exactly are the taxes refunded for a paycheck? Agencies and employees often assume that the refund checks that arrive on, for example, October 21st, are refunding the taxes from that October 21st paycheck. But actually, the refund checks the employer receives on October 21st are being refunded from the September 9th paycheck due to the 6-week lag in the workers' comp exclusion program. When the program was developed, the lag was built in to allow agencies additional time to enter workers' comp transactions, as it's not uncommon for workers' comp leave transactions to be entered late. Last year, as newbies to the workers' comp team, Mara and I created a calendar of workers' comp tax refund dates for 2021 and 22 to make it easier to understand the 6-week lag and when taxes would be refunded. And we've provided you with a copy of this calendar as a handout for this presentation. If you look at the highlighted row on the bottom of the screenshot, you'll see institution pay period 24, which ran from 2/11/21 to 2/24/21 and was paid on March 11th, 21. The workers' comp tax refunds for that check were issued on April 22nd, 2021. Seems pretty straightforward when you can see it in black and white, right? But the 6-week lag does create one problem that can be quite confusing. The IRS requires that federal tax refunds be issued in the year in which the taxes were collected. But the lag makes it impossible for us to issue refunds for the final 3 paychecks of each year in that year. To resolve this issue, OSC completes a process we call a workers' comp cleanup. You can see this highlighted in a larger box at the top of the slide. These 3 paychecks will be caught by the first prior year workers' comp cleanup of the next year, which we'll talk more about in a few minutes. So let's take a look at this in action. Here's a screenshot of the workers' comp leaves page in PayServ. Mara will be talking more about this page later in the presentation, but I just wanted to show you what the workers' comp exclusion programs are looking at. Oops, did I skip a page? I skipped a page. Sorry, guys. This is a screenshot of the workers' comp leaves page in PayServ. I just wanted to show you what the workers' comp exclusion programs are looking at when it compares the leave on this page to an employee's paycheck and how that relates to the 6-week lag. In this case, we're looking at a paid workers' comp leave that lasted from 11/6/2020 to 2/27/2021. If we look back at our calendar, we can see that this employee would not have received any tax refund checks for this leave in 2020. Because many of your employees know that these workers' comp earnings are supposed to be tax-free, you may receive phone calls questioning why there are no refunds. This calendar should help you explain the process. Now let's take a look at the workers' comp exclusion pages in PayServ. Click Happy. The first thing that we'll look at is an exclusion for a full paycheck. You'll continue on with the same employee and review their March 11, 2021 paycheck. In the Paycheck Information section of the Workers' Comp Exclusion tab, you'll find the earnings information for this paycheck. Here you'll see the issue date of the check, as well as the pay begin and end date of the check. In the Paycheck Earnings Information section, you can see a breakdown of all the earnings codes included in the check and the excluded amount for each code. If you add these amounts together, you get a total workers' comp exclusion for this check of $29.5126, which is also the amount of the total earnings for this check, as shown in the highlighted portion of the Paycheck Information section. If you look closely at each of those earn code rows, you'll also notice the earns begin and earns end dates again, as well as the exclusion begin and end dates. For a check with a full exclusion, these dates will be the same. So you'd think that issuing a refund for this check would be as easy as just refunding the exact amount of taxes that were initially withheld from it, wouldn't you? But not quite. If you go over to the next tab, the Workers' Comp Pre-Tax Deductions tab, you'll see that the employee had $61.73 of regular before-tax health deductions withheld from this check. We can't refund taxes from a pre-tax deduction, so we need to adjust the workers' comp exclusion by the pre-tax amount. In the highlighted taxable wage adjustment section, you can see the actual adjustment that was made to the employee's federal, state, and FICA taxes, taxable gross, which for these checks was a negative adjustment of $2,889.53, or $2,951.26 minus the pre-tax health care of $61.73. So the system adjusts the employee's taxable gross for each of these three tax categories by that amount and calculates the taxes that would have been withheld from that amount and refunds accordingly. Sort of hidden on this page is something else I think that you at the agencies might find helpful. You can see the date of the refund here, listed under date applied in the highlighted box, and the refund method. If you see Payline here, you'll know that the employee has received a check for each of these three refunds. And here's the WFA, or Workers' Comp Federal Wage Adjustment refund check for this paycheck. Under Other Earnings, you'll see the earn code and the description, as well as the amount of the adjustment. In this case, based on the employee's individual tax withholdings, the federal tax refund on a negative wage adjustment of $2,889.53 is $402.37. Now let's look at the workers' comp exclusion for the same employee's next paycheck. If you remember back to the workers' comp leaves pages, the employee's leave ended on 2/27/21. So the next paycheck, issued on 3/25/2021 and covering 2/25/2021 through 3/10/21, will only include 3 days that should have been non-taxable. Again, you can see the full breakdown of the employee's earned codes for that check, but in this case, the exclusion end date is 2/27/21. The last day of the employee's workers' comp leave. The excluded amount is calculated for each earn code and totaled at the top of the screen. In this case, the excluded amount is $599.02 for those 3 days of workers' comp leave. But we have to adjust for their pre-tax deduction, right? You might be tempted to ask. Oh, come on. There we go. Sorry. In this case, no, because the employee has other taxable earnings left in this paycheck, we don't need to adjust for the pre-tax deduction. The employee's taxable gross for federal, state, and FICA will be adjusted by the full exclusion. And here's the employee's WSA, or Workers' Comp State Wages Adjustment refund check. You can see the adjustment of negative $599.02 to the employee's gross taxable state wages and the refund of $11.04 that resulted from that adjustment. Now let's take a look at a check that included retro earnings. The workers' comp exclusion programs refund taxes on retro pay on the same 6-week lag and do the same compare of the workers' comp leaves page when it sees retro pay. In the case of this employee, they received a retroactive pay for a time when they were on workers' comp leave the previous year. The system saw that retroactive pay and calculated the appropriate exclusion amounts for those retroactive payments. And just like with the partial leave paycheck, the exclusion will not be adjusted for the pre-tax deduction as there were other taxable earnings in the paycheck. And again, here's the refund check for the employee's WSM, or Workers' Comp Social Security Medicare Wages Adjustment. The system adjusted the employee's FICA taxable gross by negative $572.33 and calculated a refund of $43.79 on that amount. For each of these 3 examples that we've reviewed, the employee received 3 refund checks, 1 each for federal, state, and FICA. Now let's talk about our workers' comp cleanup process. We complete 2 kinds of cleanups over the course of the year. prior year cleanups, and current year cleanups. Prior year cleanups correct an employee's taxable gross for federal, state, and FICA taxes, generate a corrected W-2 for the year of the cleanup, and create FICA refunds or FICA deficiencies depending on the nature of the change. IRS regulations only allow us to issue prior year refunds for FICA taxes, so it's up to the employee and their tax preparer to determine what to do with the information on the corrected W-2. OSC cannot provide tax advice to employees. Prior year cleanups are necessary for one of two reasons: either to clean up the taxable gross for those final 3 paychecks of the year, as we discussed earlier, or to correct the taxable gross for employees with late changes to their prior year workers' comp leave. For employees owed refunds from the final 3 checks of the year, or who had late workers' comp leaves entered for a prior year, the cleanup process results in a decrease to their taxable gross for that year, generating a FICA refund. For employees who had workers' comp leave canceled for a prior year, an increase is made to their taxable gross and a FICA deficiency is created. We run a series of these workers' comp cleanups throughout each year, beginning with the year immediately prior in late February, and then moving to the final cleanup of the year, which is approaching the statute of limitations for changes to W-2s, which is 3 years, 3 months, and 15 days. As an example, in February of next year, we'll run the first 2021 cleanup and the final 2018 cleanup. Then over the course of the year, we'll run cleanups for 2019 and 20, as well as one more 2021 cleanup. The first prior year cleanup each year is the biggest cleanup we run, as it includes every employee with workers' comp leave paid in the final 3 paychecks of the previous year. We also run 2 current year cleanups each year. These cleanups create adjustments to the employee's taxable gross and generate FICA deficiencies or refunds. We use PayServ bulletin board messages and payroll users group announcements to keep agencies informed about the cleanup process. So you'll see these messages whenever we are either preparing to run a workers' comp cleanup or have just completed one. These messages provide information and instructions about the cleanup, including deadlines for any agency action. These deadlines are important because when we process a cleanup batch, all employees in that batch are processed simultaneously. Let's take a look at the workers' comp earnings exclusion page for a prior year cleanup for our earlier employee with workers' comp earnings during those last 3 paychecks of 2020. If you remember the earlier screenshot from the workers' comp leaves page, this employee was on paid workers' comp leave from 11/6/20 to 2/27/21. Since the 12/30 paycheck covered the 11/5/20 to 11/18/20, you would expect this to only be a partial exclusion. But as you can see, the total earnings and the workers' comp exclusions match, meaning this check should be fully excluded from taxation. How is this possible? Let's take a look at the paycheck earnings information section, where you will notice that each of these earn codes actually has 2 rows. One row with the 11/6/20 date, begin date, and 11/18/20 exclusion end date, and one with the 11/5 exclusion begin and end date. We can infer from this that at some point a correction was put into the employee's history to add another day of paid leave for this employee, and that additional day of leave makes the entire 12/30/20 paycheck fully excludable. As I mentioned earlier, in addition to cleaning up the final 3 paychecks of the year, the workers' comp cleanup programs also look for other late changes to the employee's workers' comp leave. And looking at the workers' comp pre-tax deductions tab, you will see again, because this was a full exclusion, that we had to subtract the value of the employee's regular before-tax health from the excluded total. So for this check, the actual adjustment to the employee's taxable gross for these categories is negative $2946.49, which you can see in the taxable wage adjustments section of the page. Here, you'll also see a different refund method. Instead of payline, indicating that the refunds will be issued in a check, you see request posted, which indicates that any adjustments to taxable gross or refunds owed for this paycheck will be handled as part of the cleanup process. Each cleanup is completed in 2 batches, a positive batch, which increases the employee's taxable gross and results in a FICA deficiency, and a negative batch, which decreases the employee's taxable gross and results in a FICA refund. In this case, the employee had a decrease to their taxable gross, received a corrected W-2 for 2020, and is also eligible for a 2020 FICA refund, which we processed in a negative batch. When an employee is eligible for a prior year FICA refund, they have two options. They can file for the refund themselves, or they can give consent for OSC to obtain the refund on their behalf. After the cleanup program determines that a FICA refund is available to the employee, the NTAC 722 report is created, which lists all employees eligible for FICA refunds due to that cleanup. OSC posts a bulletin board message in PayServ instructing agencies to review their report and reach out to affected employees to inform them of the refund. Agencies are also instructed to obtain an AC 3206 consent form if the employee wants OSC to obtain the refund on their behalf. We are required to provide at least 45 days for you to contact the employee before we process these refunds. This deadline is provided in the bulletin board message. Once you have collected the signed AC 3206 from the employee, you will let OSC know that the employee has provided consent for us to obtain this refund. To do this, go to the Employee W-2C AC 3206 page in PayServ. The path is listed on your screen. And click the Refund Consent Received checkbox. When we process the refunds for this negative batch, the system will review the AC 3206 consent status for every employee in the batch. If the refund consent received box is not checked, we will not issue the refund to the employee, and it will be up to them to file for the refund on their own. These refunds do take several months to process, so please be sure to explain to the employee that it will be some time before the refund appears in their paycheck. If the prior year cleanup program generates a positive adjustment to the employee's taxable gross for that year, the employee will owe a FICA deficiency. After the cleanup programs have calculated the deficiencies, the workers' comp team enters general comments for each affected employee. The general comment will include the year for which the deficiency is owed, the amount of the deficiency, the percentage at which it will be collected, and the date of the first paycheck to be deducted. These general comments will appear on your NPay 776 Consolidated Correction Sheet report, and we will also post a bulletin board notice when we process a positive workers' comp cleanup batch resulting in FICA deficiencies. General comments are entered at least 2 full pay periods prior to the start of collection to give agencies time to notify employees of the impending deduction. To assist agencies with the employee notification, Payroll Bulletin 1493 includes a letter template that agencies can use when notifying employees of the upcoming 502 FICA deduction. When we're ready to begin collection of the deficiency, the workers' comp team enters the 502 FICA deficiency deduction for each affected employee. These deficiencies are entered at 10% for active employees and 100% for inactive employees and will be taken from each paycheck until the deficiency is satisfied. Before I hand the presentation over to Mara to talk about workers' comp transactions, I'm going to address one of your most frequently asked questions. What about those $0 refund checks? There are 2 main reasons why you'll see those $0 workers' comp refund checks. The first is refund checks processed through the regular workers' comp exclusion process that don't generate a refund. Because the refunds are based on the taxes that would have been withheld from the excluded amount, rather than a one-to-one refund of the taxes withheld from the initial check, it's possible that nothing will be refunded and a $0 check will be generated. The other reason for the $0 checks is modified leave. In these cases, the system makes a positive adjustment to the employee's taxable gross, but since these adjustments are not earnings, there are no taxes withheld from them and no refunds to be given. Let's take a look at both situations. The first is a regular workers' comp exclusion with the original check date of 6/17/21 and the refunds applied 6 weeks later on July 29, 2021. The workers' comp exclusion for this check is only $363.61 because the employee was only on workers' comp leave for 2 days of this pay period. The system calculated a negative adjustment to their taxable gross, then reviewed the employee's tax withholdings, And because they had a large number of withholdings, no taxes would have been taken from that $363.61 of earnings, so no refund is generated. And here's the $0 net pay check that was the result of that. You see the adjusted amount with the WFA, Federal Adjustment Earn Code, but there are no taxes to be refunded on this amount. And then if we look at the exclusion page for an employee with multiple modifications to their leave for the 7/21/2016 paycheck, if you look at the taxable wage adjustment section, you'll notice rows with 3 dates of refunds applied. The employee received an initial tax refund with a 9/1/2016 check, then their leave was canceled and a positive adjustment was made to their taxable gross with the 12/2/2016 check, and later, as the result of a prior year cleanup in late 2017, we adjusted their taxable gross once again when their workers' comp leave for this pay period was changed a second time. We're concerned right now with the changes made in December of 2016. These changes would have resulted from the final current year cleanup of that year. During the current year cleanup, the system reviews all workers' comp leaves and changes and adds workers' comp exclusion rows for all of the adjustments that it finds that are necessary to individual paychecks. In this case, for this check, the positive adjustment of $2731.48 that we see here was combined with many other positive adjustments, but still resulted in another check with a $0 net pay. When you look at the $0 check, you see the positive adjustment of $17,208.33. That's the combined total of the exclusions from all of the corrected checks. This is because the system totals all of the adjustments from the current year cleanup and puts them on one check. Because this FICA earns code reflects a positive adjustment to the employee's taxable gross earnings, there are no earnings to be taxed and no refunds to be provided. This adjustment resulted in a FICA deficiency, but because this deficiency was for a current year cleanup, which is a fully automated process, no general comments are created for these deficiencies. The workers' comp team will post a PayServ bulletin board message after we run a current year cleanup, telling agencies to review their NBEN 534B report for a list of affected employees and reminding them to notify these employees of the upcoming FICA deduction. And now I'm going to hand the presentation over to Mara to talk about job transactions and correct history requests.
Okay, hi everybody. My name is Mara Koster, and I'm a payroll analyst trainee on the workers' comp team. I'm going to be going over the process of entering workers' compensation leaves in PayServ through both job data transactions as well as correct histories through job action requests. So each time an employee is placed on workers' comp leave in PayServ, the incident details and injury details pages need to be filled out. If you don't fill out these pages for the employee and leave date in question, PayServ will give you an error message and it will not allow you to enter the row. If you're returning an employee from workers' comp leave, the incident and injury pages do not need to be entered for that re and leave date. So we want to start with the incident details page. If you have an existing incident that you want to edit, you can search for that here. Otherwise, click on the Add a New Value tab and then the Add button, and the system will generate a number for your incident. So once you add an incident number, this is what you'll see. And these red arrows are pointing to the only fields that you really need to fill in. For the incident date, enter the date that the employee's initial accident occurred. Then check the resulted in injury or illness checkbox down at the bottom. And you can also check the recurrence box if that applies. So now we can move on to the notification tab at the top of the page. Again, these red arrows are pointing to the only fields that are required. For the date reporting field in that top section, this is the date of the specific leave instance you're entering, so the date that you want to remove the employee from the payroll. And the same date should also be entered under the date recorded field down at the bottom. This is what allows you to enter a workers' comp leave and job for that date. If any other date is entered here, when you go to enter the job row, you will get an error message that says that the incident details are missing or incomplete. So now for the ID, be sure to enter this in the reported by field only and leave the reported to field blank. If the reported to field is filled, this will also cause an error message. So once you've completed these two tabs, you're all set as far as the incident details go. The other tabs at the top of the page can be filled out, but it's really up to you and your agency's discretion whether you want to use them. So once you save the page, you'll receive two pop-up messages, and you can just click OK through them. These are soft warnings, they're not errors. And the incident number will be assigned once you save. It will appear in place of those zeros at the top of the screen. And be sure to make a note of this number because you'll need it to fill out the corresponding injury details. So next we'll fill out the injury details page. And if you navigate to this page directly from the incident details, it may automatically bring you to a panel for the incident number that was just assigned. If not, it will bring you to a screen where you can search for that number. So on this page, all you need to fill out is the EMPL ID and the date of the leave in the date reported field. The EMPL record field will default to 0, so if the employee's leave is under a different EMPL record number, be sure to enter that here. The description tab is not required, but again, it can be used if you choose. So now you can go ahead and save the page, and you're all set to enter the leave row and job, which we'll go over next. Now, while the incident and injury details do currently need to be filled out for each workers' comp leave row, it is one of our goals in the future to have this requirement removed. And once we're able to make that happen, these pages will still be here, but agencies will be able to decide whether they want to use them. So now that the incident and injury details are complete, the leave row can be entered. Agency personnel can only enter rows in job if the effective date is after the highest dated row in the employee's history. So in the example on screen, the latest row in the employee's history is a return from paid workers' comp leave on July 16th. So let's say this employee began an unpaid workers' comp leave on July 17th. This transaction could be entered by the agency. On the other hand, say you found out after the fact that this employee actually began their unpaid workers' comp leave on July 1st, after that first paid leave. This would be a correct history, which should be submitted in job action requests, which I will go over in a bit. So just a few more things to note when you're entering transactions. Job rows should never be deleted. This could mess with the employee's taxes or pay calculations that occur behind the scenes. If an incorrect row was entered, please submit a job action request with the correct information, and we will take care of it. Also, be sure to refer to the payroll submission schedule when you're entering transactions. We advise agencies to avoid entering on Tuesdays and Wednesdays, as this could interfere with the Paycheck calc and confirm. If an employee is going directly from a paid leave, or the PLA codes, to an unpaid leave, or an LOA code, a re-in leave in between is not necessary. But if you're moving an employee from an LOA to a PLA, you will need to enter a return row between these two. Also, if an employee is moving from one unpaid leave to another, for example, if they've reached their maximum 1 year of workers' comp benefits, so they need to be moved from the unpaid workers' comp code to an unpaid sick leave, it is also necessary to return them from leave and to put them back out. So now I'm going to go over the process of entering a workers' comp leave row. In the effective date field, enter the first day of the employee's leave, which should be the date you filled out in the incident and injury panels. Or if you're returning the employee from leave, enter the date that they should go back onto the payroll. In the action field, you can use the drop-down menu to choose leave of absence, paid leave of absence, or return from leave. Then in the reason field, enter the appropriate workers' comp code. A list of our valid codes can be found in Payroll Bulletin 1366. We're always referring people to this bulletin. It's super helpful. If you enter an invalid code, the reason field will turn red and you will get an error message. This is also what will happen if the incident and injury details have not been entered for this effective date. The effective sequence number will default to 0 for each row you enter. If you're entering a row and there's already an existing row for that date, you'll need to change the sequence. The bottom row should always be 0, and you go up a number for each row you add to the top of the stack for that date. If you need to change the employee's work percentage, for example, if you're placing them on the PLA SWC code, which is Workers' Comp Sick Leave at Half Pay, go to the Job Information tab at the top of the screen. And here you can change the part-time percent field to 0.5 or whatever percentage is necessary. Just make sure that when you're entering a return transaction for an employee who was on a half-pay leave code, you flip that percentage back to 1. And once these fields are filled in, you can save the page. Once a row is entered in job data, you'll be able to see it on the Employee History page. A corresponding panel for each leave is also automatically generated on the Employee Workers' Comp Leaves page. So as you can see, this employee began their paid leave on June 8th and was returned on June 15th. So here on the Employee Workers' Comp Leaves page, this is what was created by the system when that leave was entered. You can see that the leave dates are the same. Sometimes panels on this page are flagged for review, so we run a query once a week to identify and review any flagged leaves. Like Ruth said earlier, employees' workers' comp tax refunds are generated from this page, so it's important that these panels are accurate. When job rows are deleted or existing rows are altered, it causes issues on this page, which could then impact the employee's taxes. So this is one of the reasons why job rows should not be deleted or changed. Okay, now I'm going to move on to talking about workers' comp correct histories or core HIS. So just last month, we published Payroll Bulletin 1945, which announced that we have a new data change reason code for job action requests related to workers' comp. So now when you're submitting a job action request for a workers' comp leave, you should use the data change code WCR. We run a query several times a week to review and enter these transactions, and this new code is going to help us streamline that process. Please also note that any auto-pay requests related to these job roles are still reviewed by OSC earnings, so they should be put into a separate request under the original data change code COR. So under this new WCR data change code, please continue to include the leave effective date and the workers' comp code you're requesting in the status reason box. Again, workers' comp codes can be found in Payroll Bulletin 1366. If you're requesting multiple rows for the same employee, you can put them all in one request. There's an example of this on screen. These requests are usually brief enough to fit in the status reason box, but if you run out of characters, you can enter it in a general comment, and in the status box, just let us know to look there. It's also helpful to us if you switch the sequence number on this page to 9. It will default to 0, but this may interfere with the job row once we go to enter it. If you're requesting to change the date of a leave row that's already in the employee's history, please either enter incident details for this new date or update the existing panel with the new date. And like I mentioned before, we can't delete rows from an employee's history, so sometimes it's necessary for us to enter what we call a dummy row. For example, if a re-and-leave row for an employee has already been entered, but you request a core HIS to return them on an earlier date, we will need to enter an entirely new return row instead of updating that existing row. These two return rows next to each other will cause an issue, so to avoid this, we'd enter a dummy leave row in between. These will be entered under the sequence number directly below the original re-and-leave row, so it will effectively be canceled out and it won't impact the employee's history at all. So now I just want to quickly talk about a few processes we have for reviewing employees who are on workers' comp leave and PayServ. Employees in most bargaining units are entitled to up to 1 year of workers' comp benefits. We have a query that we run once a month to identify employees who have surpassed this year. We then email each employee's agency to let them know that the employee should be switched to a sick leave or another non-workers' comp leave. Now, if an employee is out due to an assault, they are entitled to be on leave for 2 years, but they are still only entitled to the typical 1 year of tax benefits. they should also be switched to a non-workers' comp leave once their first year is up. For these employees, a general comment should be entered explaining this switch. And finally, earlier this year, we began conducting a quarterly review of all current workers' comp leaves. So 4 times a year, we will be sending each agency a list of their own employees who are currently shown on workers' comp leave in PayServ. Agencies can compare this list to their own records to make sure that PayServ is up to date and that no transactions were missed. And we've sent this outreach twice so far, and it does seem to be catching some things, which we're very happy about. Okay, I hope this has been helpful, and I'm going to pass it back to Ruth now.
Thank you, Mara. Next, we're going to finish out today's session with a review of supplemental workers' comp payments. These are payments made to employees in certain New York State bargaining units whose contracts provide supplemental benefits if the New York State Insurance Fund's workers' comp award does not equal 60% of the employee's pre-injury gross biweekly wage, including certain additional pay factors. Eligible employees are entitled to receive 195 days of supplemental payments, and it's the workers' comp team's job to track those days of eligibility in addition to actually calculating some of those payments. We process supplemental payments for institution and admin agencies on alternating weeks. We're actually always a week ahead of the rest of the Bureau. For example, this week we're working on supplemental payments for institution employees while the rest of the Bureau is getting ready to confirm next week's admin paychecks. Fun fact, we process about twice as many supplemental payments for institution agencies as we do for admin agencies. To process these payments, OSC receives a weekly file from NYSIF containing all of the workers' comp awards they've paid to New York State employees since their last report. This file loads into PayServ and creates a new row on the employee's workers' comp data page. Once loaded to PayServ, some of these payments calculate automatically and require no review or manual calculation by the workers' comp team. The rest of the payments require review by the workers' comp team, and we break those down into 3 categories. The first is clean payments, which require review because the employee is approaching the 195-day cutoff for supplemental payment eligibility. We review their supplemental payment history and enter a general comment with the date they reached the 195 days and the claim number. If the employee is injured again, that 195-day clock starts over again with the new case. Clean payments can also be caused if there is information missing from the employee's record, making PayServ unable to calculate the award without manual review. Often this is caused by missing award information from NYSIF for an earlier period of time, or because NYSIF is attempting to pay an award for an employee who isn't shown on workers' comp leave in PayServ for a portion of the period being paid. In those cases, the workers' comp team will reach out to NYSIF and the agency to determine what the employee's workers' comp leave should be. The next type of payment that requires review is unresolved payments. These are usually cases where the information NYSIF submits has overlapped a prior payment, or where there is no workers' comp leave in PayServ at all for the entire period that NYSIF is paying. Again, the workers' comp team will contact both NYSIF and the agency to solve the discrepancy. The final type of supplemental payment that requires review is recaps. These are the results of after-the-fact changes that NYSIF has made to an employee's award history based on new medical evidence, judges' decisions, or other factors. These changes can mean that an employee may now be eligible for a supplemental payment that they weren't eligible for previously, or that the employee may no longer be eligible for a supplemental payment they've already received. Because the employee had no way of knowing that these changes would be coming, we do not recover supplemental payments if they were overpaid due to NYSIF's changes. Not everyone who comes through on NYSIF's file is actually eligible for a supplemental payment, but because the workers' comp data page is also the method by which we report retirement service days and salary information to the employee retirement system, it's important that all transactions flagged for manual review are looked at by the workers' comp team. When a supplemental payment is made, it appears as earnings code WPS on the employee's paycheck and is non-taxable. On that check, you'll also see the RSA, or retirement salary, reported for that period of time, and the workers' comp award information provided by NYSIF. These are for informational purposes only and are not actual earnings. While NYSIF often submits workers' comp award information in 10-day biweekly increments, this isn't always the case. We've seen award information paying more than 100 days in the same pay period at pay end date. In those cases, the employee's supplemental payment can be quite high, and it's important to review the earnings begin and earnings end dates if you have questions about a substantial supplement that you've seen. The workers' comp team is in frequent contact with NYSIF claims examiners to ensure that all supplemental days are counted accurately and all supplemental payments are calculated correctly. Let's take a look at a simple example of a workers' comp supplemental payment. Here you see award information for pay period end date 8/4/2021, covering earnings begin date 6/17/21 through earnings end date 7/29/21. Based on the information we received from NYSIF, we calculated the supplement on 31 days, shown in the highlighted supplement days field. In this example, the SIF award exceeds 60% of the employee's pre-injury gross biweekly, so no supplement is being awarded. Because the employee worked full-time, we also reported 31 days of service credit to ERS, along with the salary the employee would have received had they been working full-time during this leave. If you look at the other highlighted box, you'll see that the total number of supplement days being applied to this case for this employee is 36 days. This is because we have to manually adjust the supplement days to include several factors which count toward the employee's 195-day supplement eligibility. To see what caused this 5-day adjustment, we'll look at the workers' comp claims supplement page. This is where the workers' comp team tracks all of the time between when an employee is injured and when they reach the end of their 195 days of supplement eligibility. This page lists the claim number, accident date, department the employee works for, and the projected supplement end date, which starts at 195 days after the employee was injured, but is often adjusted if the employee returns to work during that time. In the upper highlighted box, you can see the 31 days of supplemental pay calculated on the workers' comp data page we were just looking at, and the 5 days of adjustment for a total supplement days of 36. In the supplemental days adjustment section in the lower highlighted box, we track all time since the employee's date of injury and any adjustments made to their supplemental days. In this example, you can see a row for the time that the employee worked after they were injured on 5/22/21, which is the accident date shown above, and a row for the 5 days of accruals that the employee is entitled to charge prior to going on the unpaid workers' comp leave. Days worked don't count toward the employee's 195 days, but the 5 days of accruals do, so we enter these adjustment rows so that we can track all of the days. Time when NYSIF has determined that the employee was less than 51% disabled also counts toward the 195 days. In the example here, you can see that on pay end date 8/4/21, we calculated a supplement for 26 days. But the total supplement days for this employee is currently at 50 days. Let's look at the workers' comp claim supplement page to see if there are any supplemental day adjustments in that 50-day total. And yes, we can see that the supplement days calculated on the workers' comp data page equals the 26 days we were just looking at, but that there are also 24 days of adjustments to the supplemental days count. In this case, we can see that the employee worked for some time after their injury, then had 5 days where NYSIF determined their injury was less than 51%. And then there's a gap in time from 6/2/21 to 7/7/21. If we look back at the pay end date of 8/4/21 on the workers' comp data page, we can see that we paid those 26 days. Oops, wrong screen. Sorry. There it is. We paid those 26 days that NYSIF reported the information to us, for which NYSIF reported the information. NYSIF also reported that the employee was at less than 51% disabled for the period from 7/8/21 to 8/4/21, so we've added that here as well. NYSIF later changes their determination. The workers' comp team will delete or change these adjustments to ensure that the employee's supplemental days are counted accurately. So far, I've shown you two fairly straightforward examples of supplemental payment calculations. Let's look at something a bit more complex. If you read the workers' comp data page on your screen from bottom to top, you'll see that there are large gaps in the days being paid. First, notice that the bottom row was paying an award in 2019 on a claim ending 646. This claim had only 10 supplemental days total counted toward it. If the employee goes out on workers' comp leave for that injury again, they will still have 185 days of supplemental eligibility. The next row up is for a different claim ending in 991. An employee's eligible supplement days start again at 0 with every individual claim. So for this claim, we can see the employee has used 129 days of their total supplement days. And if you look closely, you'll see that the total supplement days is shown at 129 for both rows that you can see for this claim. This is because the total supplement days updates every row for this claim when new supplement days are added. So each row for this claim will display the current total amount of days used. It's not a running total. You'll notice a gap in time between 3/7/21 earnings end date and the 6/17/21 earnings end date, or earnings begin date for the next payment on this claim. But you know that OSC has documented what happened between those dates. So let's take a look at the workers' comp claim supplement page one more time. This accident occurred on February 19th, 2015. In the upper right box, you'll see that in the time since then, we've counted 100 days of supplement on the workers' comp data page and made 29 days of adjustments. If you look at the supplemental days adjustments section, you'll see what those adjustments were for. For this claim, the employee has been in and out of work repeatedly, had periods of less than 51% disability, and also had days for which they provided no medical evidence, which also counts toward their 195 days of supplement eligibility. Note, if this employee was out on another workers' compensation leave, which we know they were from the other claims row we saw in workers' comp data, we list those days here as worked, since those days will be tracked under the other claim. Though I don't have an example to show you, we also track days that are considered abeyant, and these days also count toward the employee's 195 days supplemental eligibility. These are days where NYSEF has accepted the case, but has not yet made a determination or paid any awards. The majority of the time, we later delete these days because NYSEF has paid an award for them, and we don't count any day twice. It's important for you at the agency to understand how to read these pages because you also have a role to play in retirement reporting for employees on unpaid workers' compensation leave. Employees on unpaid workers' comp leave are still entitled to service credit for those days, and the mechanism we use to report these days is the workers' comp data pages. Any time for which we are able to record the employee's retirement salary and service days on that page will automatically load to the retirement system. But any period of time for which there are gaps in those reported days due to the employee being injured at less than 51%, or the case being abeyant, or there being no medical evidence for a period of time is not reported to the retirement system. For those gaps, or for any period of leave after the 195 days of supplemental eligibility has passed, you must supply that information to the retirement system on Form RS-2050. Finally, did you know that the following unpaid additional pay codes count toward the employee's retirement earnings even when they are on an unpaid workers' comp leave? It's true, the employee should be left on inconvenience pay, location pay, geographic pay, and shift differential while on the unpaid workers' comp leave. Please don't cancel these additional pay factors for your employees on workers' comp leave. If you remove them from this leave, any supplemental payments that are able to calculate automatically will be incorrect, resulting in an inaccurate retirement salary being reported for the employee, and, of more immediate importance for the employee, an inaccurate calculation of their supplemental benefit. As mentioned earlier, we'll prepare a handout with responses to any questions we received during this presentation and post it online later this week. And as always, anytime you have workers' comp questions, you can send them to our mailbox. Mara and I will respond to them as quickly as possible. We thank you so much for joining us for today's training session, and I hope we helped clear up some of your most pressing workers' comp questions.
Thank you, Ruth and Mara. That was a really, really good presentation. I'd like to thank everybody who attended today's presentation. We are going to leave the Q&A box up for a few more minutes, so if you have any more questions, feel free to type them in now. And as Ruth reminded you, they will be posted on the website along with this presentation at the end of the fall conference. Our next payroll course is actually going to be this upcoming Friday from 10 to 11:30. It's Navigating Retirement and Savings Plans in PayServ 9.2, so we hope to see some of you there as well. Thank you all and have a good day.